Welcome to the tax planning unit standard. It's one of the most technical, so it's important that you pay very good attention, to the details. We don't have much time, as we explained before. This is a very high intense course, so we really need to keep pace. So the unit standard covers proposal to optimize the test aspect of the wealth management of an entity. An entity, like we said before, could be an individual or a company. So we are looking at the unit standard 242574. Just make sure that you have the correct material so that you can take notes and keep pace for yourself. All right, let's go right ahead. What are the outcomes we are looking at on this one? We are looking at showing insight into how different assets and instruments are taxed. So instruments and assets would refer to different asset classifications, properties, equities, and the likes. Analyzing the current tax position of an entity, that would be, checking where are they, analyzing on your client's tax issues. Are they efficiently handling their tax issues, or is the tax eating away out of any potential wealth that they have or that they've already created? Identifying any tax solutions and presenting a possible solution to optimize tax aspects of a wealth management portfolio. So that's what this unit standard is all about. If you're new to tax, don't worry. We'll try and simplify, and this is not as intense as at level 6, which is a national diploma, or at level 7, which is a degree, or even at honors level. This is basic. It will be an introduction to tax. And this is also good for you as an individual, even if you're looking at going into business in the future. So let's talk about the definitions. What are the different definitions under tax? So everything is actually, considered under income tax, or the Income Tax Act. So the first one is gross income. So most of these things are actually considered to be gross income. They fall under gross income. So that the gross income would be income that is before any deductions. If you look at your pay sheet, for instance, or pay slip, you will see that there's the income that you receive directly before any deductions go out that will reduce your taxable income. And we'll talk about taxable income a little later. And then there's exemptions under Section 10. Exemptions are the things that are not taxable. For instance, at some stage, dividends that are paid to individuals were tax exempt. It means you were being almost compensated for investing in South Africa as a South African citizen. Now, dividends are no longer taxed, only dividends that go into companies. It means if a company has invested in another company, then those dividends are tax exempt. So, but just think of tax exemption, it means the income that is not taxed. And then we look at income. Income would look at the tax before or after exemptions. So this is income. We look at the tax before, after exemptions. And then deductions would be then your different kinds of deductions. Medical aid, for instance, contributions are deductions. Retirement annuity are deductions as well. So those are the deductible expenses. Then they would lead to taxable income. In fact, let me just correct something here. So it's gross income. These follow a certain sequence. It's gross income. Gross income is before exemptions. And then after gross income is income. Then after income is deductions. So the deductions would be that portion of your medical aid that gets deducted, your medical aid contributions that get then deducted from your income to reduce your taxable income. Retirement contributions are also a deductible expense, so those deductions will actually come here under Section 11. And then you'll then have a taxable income. This taxable income is what the income, your income is going to be the bracket in which it's going to be, or the amount, the percentage in which you are going to be taxed at based on this taxable income. So it means the more the exemptions, the lower your income, and the lower your income, which is then reduced further by deductions, the lower the taxable income. So it follows that sequence. And then after your taxable income, and we'll look at a text table a little later that will help you to understand this better. After your taxable income, we're looking at rebates, and rebates are money that is almost given back to you for just being a citizen. The rebates, if you are under 65, there's a certain amount. If you are over 65, there's a certain amount, and we'll go into those details. And if you're over 75, there's also a certain rebate that you actually get annually from the government. So that also gets taken away from your actual taxable income. And then you then have your tax payable. The tax payable is what then you have to pay SARS after including and excluding whatever that needs to be added and deducted from this calculation. And then you've got your site tax, which is looking at a standard income tax. And then you've got your payee, which is also looking at when you get an income as an employee, that is payee, and then you've got your provisional tax, which is paid mostly by the people that are running small businesses or people that don't have a consistent income. So they will have a provisional tax that they probably, file their returns each and every 6 months and pay whatever that is outstanding at that particular time. So these are the type of taxes, but you would have determined the taxable income here. The percentage will then depend on what are you actually paying, site, payee, or provisional, because they are all at different percentages. Let's go right ahead. So these are some types of taxes. There's income tax, which follows everything that we've actually spoken about after, at the previous slide, that all of those things that we spoke about there are actually income. And then there's CGT, which is capital gains tax on any capital growth. If you bought a property and then it increases with a certain percentage, that is a capital growth. It's then called capital gains tax. So you are taxed at only that portion of growth, not the rest of the asset. And then you've got the value added tax, which obviously most of you already know, for each and every goods and services that are being traded, supplied. You've got your value added tax. Not all businesses are registered for VAT. That's why you won't see in all invoices are actually registered for VAT. So certain businesses that earn a certain threshold will be registered for VAT. And then you've got your donations tax. This is donations in between two parties. So when the other party receives the money, then they get taxed on that or on that whatever that they've received, whether it's a property or cash or cash in kind. And then they've got your estate duty. That is what is dutiable on the estate when someone passes away. That is then the estate duty, and we'll go into the estate duty unit standard where you will understand, we'll unpack this more further. And you've got your duties and tariffs. It could be your tariffs, income in import customs. When you're importing goods, then you have to pay tariffs, and there's all other different kinds of levies that are being taxed via municipalities and the like. So those are the different kind of, when you transfer, for instance, a property from one person to another, there's duties that we actually pay there. So those are the different taxes that we need to pay to the SARS. Let's go right ahead. So let's look at, this is the income tax table for the year 2019 to 2020. And in 2021, now we are waiting for the budget speech. The budget speech will have new tax tables, and there've been news of wealth tax to the wealthiest. So the people that are earning these amounts and above, they are going to get a very huge tax on top of the 45% on their tax already. I mean, you know, they need to share with the citizens. This is a way that the government is using to get more money into their coffers, as we know that our government has been struggling to collect taxes because there's fewer people that are employed, because it depends on the people that are actually employed. It also depends on the businesses that are open. The pandemic has actually made things worse. So the tax population is actually reducing, and the government is looking at strategies of raising more money. So we're looking at different tax brackets. I'll just explain one on how this tax table actually works out. So you're looking at the people that are earning between R1 and 205,900. These people are taxed at 18% flat rate, you know. So there's obviously people that are, you know, exempt from paying tax that are below a certain threshold. So those people do not pay tax, but they obviously have to submit their returns to make sure that the government already knows that they are employed and they are receiving an income. The minute they go into a certain threshold, and they need to start submitting their returns. So that's why it's made like this, is that everyone needs to submit their tax returns. So these people are actually taxed at 18%. We look at, when we go back to how we were defining the tax sequence, when you get to a taxable income, after you've removed your exemptions and your deductions and you get to your taxable income, then you will have 18% of that money that gets taxed at 18%, or a portion of that money gets taxed at 18%. And then you have people that are earning between slightly above 205,900, which is 205,901 and 321,600. Those people will be paying first 37,062 at first, and then anything additional, 26% of taxable income above 205,900. So they're giving you a break and say you will be taxed flat at 37,000, and then anything above will be above this 205,900 will be taxed at 26%. I hope it makes sense, so that you know that the first one that is not even calculated is the 37,000. Immediately when you earn 205,900, above 205,901, the first thing is that the 37,000 will be taxed at this 18%, and then plus the 26% of taxable income above will be taxed at 26%. Okay, so that's how you know, and it works in the same way. Between this tax bracket, first 67,144 will be taxed at this percentage, 26%, and anything above will be taxed at 31%. Okay, so that's how the tax is actually calculated all throughout, and that's how you need to know and understand it. Let's go to, and so let's look at interest rebates that we were talking about. And rebates, like I mentioned, it's almost like a refund that you're actually getting from your taxes, or a discount on your taxes based on the age as a citizen. So under 65 in 2020, that would be 79,000. That becomes your rebate. And then after your taxable income has been calculated. And then 65 and older, it's 122,300. And then 75 and older, it's 136,750. So those are the rebates that you actually get based on the age that you are in. And then we look at interest exemptions. So those are the exemptions, a portion of the interest that you actually get that gets, gets exempted. It means it's not taxable, it's not taxed. So a person younger than 65, 23,000 per annum, as well as the rebate, it's calculated per annum. So 23,000 in 2020, and then the person older than 65, it's 34,500. So those are the interest exemptions that you actually get taxed or get exempted on. And then dividends received by individuals from South African companies are generally exempt from income tax. So if a company invests in another company, the dividend that they receive is actually exempt. It means it's not taxed at all. But dividends are taxed at a rate of 20%, withheld by entities paying the dividends to the individual. So this means if you've invested money at whichever company that you invested in, or mutual or whatever listed company, if before they pay you the dividend that is owed to you, and the definition of dividends is that the company is sharing profits with you as an investor. We'll go into this when we go into asset classes or different kind of investment instruments. The 20% gets withheld before they pay you the dividend. The 20% gets withheld. They pay you then the individual with the dividend already having been withheld, and then they pay SARS the dividend. So that's how it happens with most foreign dividends received by individuals from foreign companies. Holding of less than 10% in the foreign company are taxable at a maximum effective rate of 20% via the normal tax system, not dividend tax. So the normal tax, if you receive dividends from a foreign country and you hold less than 10% in the foreign company, then you are taxed at 20%. So it means they will form part of your income, and you are just taxed at 20% from the normal tax system, not via the dividend tax system. In terms of the impact of tax into the different products, short-term insurance, for instance, there's been recent changes where the VAT has to be added on short-term insurance. So when the changes happened in terms of from 14% to 15%, the insurance industry, obviously, the short-term insurance industry felt that, because that has to be, collected back from the individual. So when you pay your premium, you also pay your VAT into it as well. In terms of long-term insurance, we've already discussed that long-term insurance payouts are not taxable, especially when they go directly to the beneficiary. In terms of medical aid schemes are tax deductible. It means when you do your taxes, they are tax deductible in the same way as retirement or pension fund contributions are tax deductible. In terms of investments, all income is actually taxable, as we mentioned, especially for individuals. Capital growth, capital gains, there's different kinds of taxes. Capital gains for capital growth, and a dividend tax for dividend income that you actually receive. It's important for you to understand these different taxes that are affected on different kind of financial products. Let's go ahead. Demonstrate knowledge on this one. We are demonstrating knowledge and insight into how different assets and instruments are actually taxed. So let's look at explore the tax implications on investment instruments, capital growth, income rebates, deductions, and exemptions. We've already discussed this. I think what's going forward is going to just emphasize on the details that you've already shared, so that we understand them better. What is capital growth? What is income rebates? Just remember that it's related to age. You always have to make reference of the actual income rebate, per growth. Per age. The people that are under 65 have a certain rebate. The people that are over 65 and the people that are over 75 have different kinds of rebates. So you just need to remember their deductions are those that are reducing your taxable income. Exemptions are those just after gross income, you then actually get your exemptions. Those are the ones that are not taxable. Anything that you receive that is not taxable. In terms of companies, we spoke of exemptions. In terms of dividends, that are exempt. So let's look at how different types of incomes are taxed. Interest, we spoke about rebates, and this is just giving the figures that under 65, 14,958, over 65, 8,190, and over 75, 2,736. In terms of dividend withholding tax, it's 20% that you actually, taxed on. So these interest rebates should not be confused as the normal rebates just per age. These rebates are in relation to interest. So the first 14,958 per annum for people under 65 is not taxed, is considered a rebate. So whatever tax that you actually pay or that you've calculated, per annum, for interest, because interest is taxed. So, or it's included as part of your income. 14,958, the first 14,958 is given you to the person or individual back as a rebate, and it goes with the years as well. And in terms of dividends, the withholding tax is 20%, capital growth gains tax is 18% for individuals and 22.4%. Remember, I said you are taxed only on the portion of the gain and not the whole asset. So let's make an example that you had an asset of 500,000. You bought this asset for 500,000. It grew to 550,000. Okay, so only the 50,000 gain, capital gain, gets taxed. As an individual, 18%, and as a company, 22.4%. Individuals, including trusts, are taxed at 18%. So let's look at the income that is exempt. We spoke about dividend as to SA companies as an example. There's other exempt incomes. Donations between spouses, for instance, are exempt. And then there's rental. Rental is income taxed. So your rental will form part of your gross income, and then you'll then calculate downwards from exemptions going downward. But the good thing is that there's deductible expenses. If you hold the assets via a company, like let's say these are properties under a company, whatever expenses that you incur, then they are expenses of a business, then they become deductible, so you can deduct anything, maintenance or whatever that you are actually spending on that property as a form of investment, obviously, on the business, then becomes deductible. It then reduces your tax, taxable income. So those are the different types of taxes on the different types of income that you should be aware of. Let's go forth. So let's analyze now the taxable position, the tax position of the entity that we are looking at. So you need to look at what are the instruments that the person that you are assisting or the company actually holds. So if they have got the equities, then you know that what is applied into equities is capital growth, because a company grows in value. So they bought each share at this particular price. When that share increases, then it means it's capital growth. When they dispose that shares, when they sell them, and then capital gains become due. Similar thing with the dividends. Dividends, also equities or shares give you dividends. So they give you both dividends and capital growth. So dividends, like we said, it's levied at 20%, for individuals, and it's exempt for companies. In terms of properties, similar thing. Capital growth in between the capital that you put in and whatever that actually came higher. The gain is actually levied at a percentage of the capital gain. Okay, it's 18% for individuals and 22.4% for companies. Just remember those figures. I'll keep on repeating them so that it becomes a repetition in your mind, and you remember them easier. Obviously, you still have to go through your material. It's important that even if your material is not updated, you use the most relevant and the most, as I've given you the certain percentages there, use the correct percentages, but because they continue to change every time, every year. Like now in February, things might be changing in terms of the different interests or tax levied on individuals or companies or trusts. Gilts and semi-gilts. Gilts, you must just remember that are bonds. So gilts refers to government bonds, and semi-gilts refers to company bonds. So a bond, we'll talk about it again on the unit standard that deal with asset classes, but a bond, when the government is trying to raise money from the public, it issues a bond. It means it's a debt instrument. It says, I'm collecting money, you borrow me money, and then I give you interest. So that would be a government, and then the company can actually issue a bond. Mostly big companies actually issue a bond. And then bonds are levied interest as well. So if the individual or whoever that you are actually analyzing, they would have interest that comes from bonds, and that interest would actually be levied an interest tax on it, income tax on it. The interest that comes from here, interest-bearing instruments, money market, for instance, or cash that's sitting at the bank, it increases because of the income that comes in. That income is taxable, so you must just be aware of that. And then offshore assets, you must be aware that there's different types of tax compliance issues with offshore assets. Dividends, for instance, that are from offshore companies are levied at the tax. We spoke about that. At 20% that is added into the income tax, especially when you don't hold shares that are more than 10%. So you need to look at, if someone holds shares from offshore, what kind of tax is actually applied there. Let's go forward. Let's look at then the current life cycle of the entity is analyzed for tax purposes. So the life cycle will go into another unit standard that goes deeper into life cycle. But this is actually life cycle. They've put people into categories and say, when you are 20 years or older, this is where you are with your life. This is what is recommended that you do. And, this is the likelihood of the tax that you will incur because of the financial decisions or, that are actually, you making at that particular time, or the income that you're accruing or that's due to you at that particular time. When you are starting out, obviously your income is lower, then your tax bracket is lower, you're paying lower income. As you grow up, the tax bracket grows with your income. But you start exposing yourself to the different types of investment instruments, then the different kind of tax is actually due, to the taxman. So here we are trying to analyze the needs and wants of an individual at different stages in the life cycle. You describe the income and expenditure typically at different stages and explain the interrelationship between an individual's basic needs and a stage in their life cycle, and then interpreting critical events that trigger entry into a new stage in the life cycle.